Hey guys, Jared Wesley here of Live Traders, and it is that time of the week. It is lecture time, and this week's topic, guys, is when is it okay to fade a stock? When is it okay to fade a gap? When is it okay to fade the market? When is it okay to fade a stock, even on a 2-minute or a 5-minute time frame? For some of you that aren't familiar with that concept, simply what that means is when is it okay to go against the market bias, or when is it okay to go against the gap? Meaning, if a stock gaps up, okay, say 10%, 20%, when is it okay to short that stock? If a stock gaps down 10, 20, 30%, when is it okay to go long and buy that stock? So today's lecture is pretty good in that it gives you more tools in your toolbox, more opportunities to take advantage of the market. Because one of the things that you hear frequently in trading is the trend is your friend. Always trade with the trend. And that actually is very valuable information, okay? And most newer novice traders should probably stick with that information. But there are times when you can there are times you can absolutely go against the trend of a stock, and that's what fading means. Go in the opposite direction of the move or the opposite direction of a gap, but you have to be very clear and very specific when you do that because, again, you're going against the prevailing trend, and that can also be very dangerous. This also means you still have to take your stop losses, you still need a pre-trade checklist, you still need money management, trade management, all of those other things. This isn't some free-for-all hoopla. Okay, it's very important, but like I said, it now allows you to trade in almost any and all market environments. You don't need the market just to go higher or lower because now you can take advantage of certain stocks regardless of where they're gapping. Gap ups, you don't just have to go long now. Some gap ups you can actually short, okay? So it's a little bit shorter of a lecture. It's only about 35 minutes compared to the hour that I usually put in, but I think it's a powerful one because, again, we're just adding more tools to your toolbox. Gives you more flexibility, more opportunity to make money out there, okay? If you like this video, please click that like button. If you like this channel, please subscribe to the channel. I'm Jared Wesley of Live Traders. Let's get to it. This week's topic is when to fade a stock, when to fade a gap. I've been getting a lot of questions about that recently, and oddly and interestingly enough, well, the market had a mega gap up today, some 3.5% on the NASDAQ. So maybe it's an appropriate day to do a lecture on this particular topic. So I think it's a good one because I think a lot of people, especially on Stock Twits and even people in the chat room, when I say, guys, look to fade the market today or look to fade this stock, I get tons of questions of why it's so strong or why it's so weak. You know, a stock that's so strong, why would we short that? Or a stock that's so weak, why would we go long on that? So it's a very important topic, and I think it adds another tool to your toolbox. There's nothing wrong with trading with the trend. In fact, most of the time you should trade with the trend, especially if you're a new trader. But there are times you can trade against the trend or when you can fade a stock. And I will say this, the markets have been incredibly strong during COVID, a little bit choppy, but strong. And I think people's expectations of normalcy have changed, and that's not going to be that way forever. We will come out of this and the Fed will stop printing money at some point, et cetera, and so forth. But the point I'm simply making is don't look at the last 6 months as normal because it hasn't necessarily been that way. So let's dig in. But before we do, when will the insanity stop? Never, right? We already talked about it. Insanity's never going to stop. But this week, another interesting one, okay, somebody sent me maybe 2 weeks ago, something like that. I've been sitting on this one for a little bit. I try to save a few here or there. But this is a particular individual who decided that cost averaging down on a losing position is a good idea. Such a good idea that they're down $70,000 on this position. So it says, hey, can you please check SDNL or SNDL? I got trapped with 200,000 shares averaging multiple times from 50 cents. The current price is 15 cents. Now, earnings on November 11th, not too far away, a week away. What do you think this particular individual is doing right now? Checking every single news report on this stock.
Guaranteed, right? Some of you out there have done this kind of stuff. You get your hand caught in the cookie jar, and now you're scouring Google or DuckDuckGo or whatever it is that you use, and you're just sitting there going, oh, what did the CEO say today? Is there any more news on this? And what's the earnings going to be like? And then you're looking at the actual earnings. Then you're looking at analysts. Is it hold? Is it buy? Is it sell? Is it strong buy? And that's what you're doing. I mean, it's absolutely insane is what this is. It's insanity. What's the job? To not put yourself in that position to begin with. Okay, so this person's down about $70,000. Guys, cost averaging down on a losing position is not a winning proposition. Now, I will admit to you, 50, 60, 75, 80% of the time, you'll get away with it. You will. I'm just being honest about it. 75% of the time, you'll probably get away with it. I don't know how long it'll take, a day, a week, a month, a year, but you'll probably get away with it. But that 10, 20, 30% of the time that you don't, it's over for you. It's over. Your account's gone. You're going to be riding that trade for, let's just say, a long-term core or investment. You don't want to be doing that, especially if you're an intraday trader. You don't have any money now. So you got to ask yourself, is it worth the 10, 20, 30% chance of never getting your account back ever? Is your ego worth that much? Obviously, to some people it is because, well, they're down $70,000 by being dumb. So averaging down on a losing position is never a good idea. Like I said, you'll get away with it 3/4 of the time, but the 1/4 that you don't, it's over. It's not going to be a small loss. It's going to be an account disastrous situation. And that's just not worth it, guys. You know the saying, live to fight another day? Do it, okay? Do it, all right? So just be smart about things. And I know it's like that Top Gun quote, your body's, your ego's cashing checks, your body can't cash or whatever the heck it is. I just mucked that up pretty good, right? Okay, don't be in that position. Don't let your ego do that to you. Take the loss. Somebody emailed me the other day, Jared, I'm down $1,300 on a stock and I should have lost like $200 on it. What should I do? I said, just get out and move on. Get out and move on. But no, get out and move on. That's it. And don't ever look back. Don't regret it. Just learn from it. So let's dig in. Okay. All right. When is it okay to fade a stock? It's a great question. And this is all chart slides. There are no text slides in this. This is the only text slide in the presentation. When is it okay? And just for those of you that aren't sure what fade means, it means go against the current direction of the stock. So if a stock is ripping higher, to fade that stock would mean to short that stock or go against it. If a stock is tanking and going lower, to fade that stock would mean to go long. It means go in the opposite direction of the current trend of the stock. When is it okay to do this? Well, let's talk about it. So BABA is a stock that we traded recently. I think as little as 2 or 3 days ago, something like that, okay? And I got a lot of questions on this because I went long on BABA. I think it was yesterday. I think you're right, Miguel. I went long on BABA. And people are looking at this and they're looking at the daily chart and they're seeing a gap down under a bottoming tail, under a bottoming tail. There's 2 bottoming tails, under a green bar, and right near this pivot. And the general consensus is, well, if we break this pivot here, this bottoming tail pivot, we should drop lower. And that's true, right? And that is true. So when you take out multiple bottoming tails and a green bar, it's generally a very bearish thing. And when you look at the gap, you're like, geez, it's only an 8% gap, 7.9% gap. Why would you ever consider fading this gap, which means to go long on this particular gap? If you're looking at the daily chart, you probably wouldn't, right? You probably wouldn't. You'd look at this and go, wow, that's a pretty bearish gap. And the market yesterday was pretty bullish. So my point simply is, wow, this stock had great relative weakness. Oh, I wouldn't go long on that. It's got great relative weakness, got room to drop. But don't stop there, because this was a stock that was actually on our short list, right? It was on our short gap list. And I said in the pre-market, I said, look, this is a stock that could go either way today. It's on my short list now, but don't be surprised if there's an opportunity to go long. Well, we move over here to the 5-minute chart. What you're seeing here is post-market, so you can see it 4 p.m. right here, all the way to the end of the evening, which is like 8 p.m. or something like that, okay? And BABA just kind of hung out. No big thing. And then the next morning, very early in the morning, BABA gaps down. but then it immediately bullies, right? Gaps all the way down to 290, bullies, and then rolls over. And this is what's really important. BABA doesn't roll, it rolls over. Okay, it goes from 300 down to like 280-ish, give or take. But in this move, it has super wide range bars, a wide range bar here, a wide range bar here, and a massive bottoming tail. And this is important because we're going to talk about it twice. The volume down here. And again, this is where I apologize that I threw this together literally 30 minutes ago. I would have normally put an arrow that says increased volume, an arrow with a bottoming tail, and an arrow with a wide range bar. I apologize for that, okay? So we have a huge bottoming tail after super wide range bars. And that's a massive volume spike. You don't think so because it's not as big as this volume here, but you have to understand this is pre-market volume. You can't expect the pre-market volume to be as high as the regular volume. It'll never be that high, okay? So for the pre-market purposes, that's extreme volume. 500,000 shares? 500,000 shares on one 5-minute bar. I'll repeat it. I know you're tired of me repeating stuff. 500,000 shares on one 5-minute pre-market bar. What does this do? Why am I spending so much time on this? Because what they just did there was set the bottom. They just set the bottom. Anytime that you get a climactic type move, this is a micro-climactic, micro-parabolic move, okay? And then you get tremendous volume with a huge bottoming tail after super wide range bars, you know that this spot right here is going to be extremely tough to move below, to get under, okay? So it bounces back up about 50% into this area. If you took 290 to 300, about 50% into that range, and then rolls over again. Well, this rollover was pre-market, but then the market opens. That's 9:30. This little dotted line is 9:30 a.m. And what happens? It tanks. But as soon as it tanks, it stops dead in its tracks at this prior pivot low, prior bottoming tail, prior volume spike, dead in its tracks. And what does it do? It puts in a wide range green bar that takes out about 70% of the red bar. And then the next bar has a tug of war, a battle. This was a red bar at one point. It was a wide range red bar right there. And then what happened? A bottoming tail was left. Buyers, 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 buyers. Okay, so what do we have? A stock that came down to give or take 280-ish and ripped higher on huge volume. It retested 280 and put in a wide range green bar. And then it retested that area again with this bottoming tail. And all 3 times or 2 times it bounced. It bounced here, it bounced on the green bar, it bounced on the bottoming tail bar. You have to believe that this is the low now. It's been tested and passed the test so many times, it's going to be really hard for somebody to say, yeah, it should go lower. Not with the kind of volume and the buyers stepping up in that range. So we looked at it right above, literally right above this green bar right there. Stop loss down here. The stock ripped. We'll take a look at it. Okay. So now what you're getting is, we saw the daily chart. Okay. Now you're getting the 5-minute pre-market that I just showed you, okay? The bottoming tail on volume, the retest, and now we're going to go over to the 1-minute chart. And you can see right here, there's the test, and this is that higher low. And that's what you want to see, right? This higher low right here, bottoming tail, higher low moves up. Could you have bought it there? Yeah, but it's pretty aggressive right there. But when you see this here on the 5-minute with the pre-market, bottoming tail, equal highs, that's a good entry. I believe it was like 284.70 or something like that. And it rips up. You know what's also in your favor? The market. The market's super, super strong. Okay? So it's not like we're going against the market trend. So when you start putting all of these things together, this ends up being a very good trade. And that's what we did. Right? We called this at 2, I think it was Cliff who first mentioned it, 284.70. You can see my orders at 284.70. You can see here on the 2-minute and the 5-minute what we were looking at, right? There's your retest of support. There's your volume spike. There's the bottoming tail. And you're looking at that 284.70 mark. And you're trying to get back about 50%. 50% is like 289, 290. Somewhere right around that range, 50%. Am I expecting this to go to 300? Not really. It's a double bottom transitionary buy setup. but you still have some resistance at 293, 294 that you have to respect. Okay, so order is in right there, 284.70, 300 shares. I missed share size a little bit. I should have had 350 or 400 shares. It is what it is. And then it rips and rips. And I put this in for a reason, guys. All right, not just so you could see a big green P&L. That's not it. I also wanted to take a side note here. This has nothing to do with fading a stock, but we talked last week about level 2, right? And that was a good discussion we had. Well, what I want you to note here is 287.99 and 288, okay? So the spread at that point in time was about 10 or 11 cents, but notice the 23,000 shares right here, okay? I want you to notice the timestamp, 46.50, because I recorded it, 46.50. At 46.51, that's 1 second later. 1 second later, those 23,000 sellers had now been taken down to 15,000 sellers right here. Okay? Less than a second later, now we're down to 8,000. Why am I commenting on this? I'm commenting on this because if this were an entry, it's not because I'm already in it, but if this were an entry, you're not going to get filled above 288. It's not going to happen. Why? Because you can see how strong the bid support is, how committed the buyers are right here. Okay? You can see here within a 1 second period, 23,000 shares goes down to 8,000 shares, and we'll take it one step further. Okay? Now again, 1 second later, so we started at 46.50, now we're at 46.52. So 2 seconds later, trade station, Tyrone, trade station. 2 seconds later, the 23,000 shares is down to 2,000 shares. And yet we see another 24,000 shares sitting at 00. Well, 2 seconds later, the 24,000 shares is down to 21,000 shares. And 1 second after that, they're gone. Gone. So you're basically talking about a stock that just chewed through 100 and some thousand shares in 3 to 5 seconds. And you're not likely going to get filled above that area. As you can see, 02, 03, not a lot of shares printed. Okay, so this was the BABA trade, but I thought it was fascinating when I went and watched the video how quickly it chewed through shares at 287.99 and how quickly it chewed through shares at 288. If this were an entry to a stock, you would have to anticipate this. I'm telling you this because this is something we talked about last week, right? If we hadn't talked about it last week, I probably wouldn't bring it up. Talk about anticipating your trades to get filled. I would say 287.97, somewhere around there. Got to give it 3 or 4 pennies beforehand. Because when the buyers are committed, man, they rip, okay? So anyway, the trade ultimately ended up looking like this, right? Bottoming tail, retest, huge volume in the pre-market, huge volume on the retest, okay? Got in at 284.70, and you can see within 3 to 5 minutes, we're almost at target. All right, we're almost at target. And unfortunately for me, I didn't do a good job of managing this. I probably should have made about $1,300 in this. I ended up making $1,100. Okay, so I did sell some of it too soon. But the play, this is a great example of when it's okay to fade a stock. This was a gap down, to be clear, and it wasn't even a bad gap down, to be clear. But we got new information in the pre-market and then after the market opened, and you have to read the chart as you see the chart. Is it slightly more aggressive because it's the first retest, the first pivot? Yes, it is slightly more aggressive. The good news is it was also at that daily support area, okay? So what you're basically looking for, guys, okay, is novice ending type gaps, novice ending type moves, all right? In this case, it happens to be a gap, right? NG, novice ending gap, okay? But I want you to take a look at it. Red bar, red bar, red bar, red bar, red bar, red bar, red bar. 1, 2, 3, 4, 5, 6, 7 red bars. And guess where the stock opens up? Here. See, you guys are all looking at the green bar thinking, oh, it's not that big. No, it's a huge gap. The stock had 7 red bars in a row down to $38, right? $38 is where it closed the previous day. And then you wake up the next day and the stock's at $34.25, $34.50. After 7 red days down, that's a tremendous gap. It's a $4 gap. $4 gap on a $30 stock is like 12, 13%. Okay? So when you look at this, you're 7 days down plus a 12% gap down. There's only one direction that this stock is going to go in, and that's higher. Right? There's only one direction the stock's going, and it's higher. And the previous day, the red day right here, was massive volume. So talk to me. I'll wait for you guys to answer. What kind of volume was this on the red day? The 7th day down red day. What kind of volume is this? Talk to me. That's it. Perfect. It's novice ending volume. Guys, every person that wanted to get out of this stock got out. Okay, we know this because not only was it down 7 days, but on the 7th day, the volume was about 3-to-1, maybe 4-to-1 in average day's volume. So when you combine, remember, one of the things we talk about, if you guys pay attention to these lectures every week, is multiple concepts converging in an area. We're always looking to add things that make our trades more reliable. That's what we're always trying to do. The more things we can add to the checklist, the more reliable the trade is, the more money we make. Well, 7 days down is great. Big gap down, awesome. But once you throw in the volume, oh boy, right? I mean, yep, location items as well. So once you start putting all these things together, you start with a puzzle that's all jumbled up. And now the pieces are starting to come together and you're kind of like, wow, I see the picture, like Jeopardy. I know what the word is now. I have enough clues and hints. I know what's going to happen here. So you get the gap down. And now the question on this is, how do we take advantage of something like this? That's the $64,000 question. On something, okay, on something as significant as this, because this is 8 days down, huge volume, etc. You could buy this like a level 1 gap. All right. And this is something I don't talk about that much, even in PTS. If you have something as good as this, you can treat this like a level 1 gap. Because what's one of the attributes of a level 1 gap? One of the attributes of a level 1 gap is how aggressive we're allowed to be with it. Right? That's the whole beauty of a level 1 gap. We can take a 1-minute high. We can nibble some in the pre-market. You can't do that with a level 3 gap. Well, a novice ending gap that's as good as this, you can treat very similarly to a level 1 gap. You can take a 1-minute high or a 5-minute high. But I would caution you, if you're going to take a 1-minute high or a 2-minute high, give it room. A lot of times, and you can see with the little tail here, a lot of times the first 5 minutes of the day, they chop around, shake people out, and then they rip. So if you're going to be aggressive with this and buy a 1 or 2-minute high, give it room. You can always add back later. Give it room. You can always add back later. And you can see that with this tail. It gapped down and actually initially went about 50 cents lower. And then it went $4 higher. Actually, 5 to the high of the day. So think about it. I know I'm repeating myself, but I know a lot of you aren't paying attention. You can be aggressive with this. But notice the 50-cent shake early on, and then it went $5 higher. How many of you have been in that position before? Shaken out early, sit there with your hand on the desk, your hand in your face going, I can't believe this stock is still going higher, and it shook me out. Right idea, wrong time, wrong stop, didn't get back in. Right? Exactly, Jonas, with Johnson & Johnson, right? So be cautious of that. The first 5 minutes a day, even with the greatest gap in the world, can be very, very whippy. Prepare for that whippiness, okay? So here's another example, okay? Here's another example. Stock's chopping around, and then goes 1, 2, 3, 4, 5, 6 days up. Volume on those 6 days is increasing each day, right? More buyers, more buyers, more buyers, more buyers, more buyers, wider range bars, huge gap up. Now you're going, that's not that big of it. It is. It's a $2 gap on a $22 stock. It's near 10%. And normally a 10% gap on a $22 stock is not a huge deal. But when it comes after 6 previous days up, and the most recent day is a wide range day on big volume, yes, this becomes a problem. So now you have gapping up after 6 prior days. It's going to pull back. It's going to pull back. Okay? Just remember, you're allowed to be aggressive. Just don't be overly aggressive. Okay? Also, and this is important, always use stop losses. I know you're tired of hearing me say it, but let's take a look to the left here. Stock has what? Green bar, green bar, green bar, right? It's very bullish here. And then it gaps down. Now, first and foremost, I would not take this. You guys know, for those of you who have taken professional trading strategies, we have excessive gap rules. So we have an excessive gap on the left and a novice gap on the right. One of these gaps is tradable, one of them is not. Okay, so this one is an excessive gap. I would only be looking long on this. I would not be looking short. And note, it actually went lower. It popped early and went lower. This gap for me is too big. $27.30 and it opens at 22. It's a $5 gap. That's a lot. I mean, that's 20%. It's too much. If it had gapped to say $25 or $26 right here, oh man, we'd be salivating for that thing. We'd be like, oh my gosh, what an incredible gap. But it didn't. It gapped down $5. So one of the things we talk about in the gap chapter in PTS, right, is excessive gaps. The more a stock gaps past support or resistance, the more it's eating into your pocketbook, into your wallet. You want stocks to gap just enough to clear support and resistance. If they gap more than that, every penny, every dollar more eats into your profitability. So you don't want to see 20 and 30% gaps if you want to try to trade the stock in that direction. Okay, so this is one where it's an excessive gap and I would likely stay away. And the only other thing I would do is think about long. If you went long on this and stopped out, oh well, it happens. They're not all perfect. That's why we have stop losses. Okay. Now, this is a slide you guys saw a long time ago. All right. I think I showed this to you guys a year or two ago. This is a parabolic trade, but using a pre-market chart. And to the average person who doesn't use pre-market charts, this looks like a bad trade. Now, I don't have the version without the pre-market, right, where this red bar here is covered. But I just want you to know for a second, this super crazy wide range red bar, that's all in the pre-market. This next bar, pre-market. This next bar, pre-market. Pre-market bar, pre-market bar, pre-market bar. If you don't look at the pre-market, you have no idea that this looks like a climactic buy setup or a parabolic buy setup. You have no idea because you're not looking at the pre-market chart. But one of the things you can do is look at the daily. And you sit here and go, okay, this particular stock closed at right around $75 the previous day, right? Right around 75 bucks. Okay, it looks to be in an early downtrend. Lower high, lower low, lower high. We need another lower low, and we're in a downtrend. The moving average is curving lower, etc. And what happens? You go up, you gap from 75 down to, we can see it right here, 55. Dude, $20 gap on a $75 stock. That's massive. So what are you looking at? A bounce. You're absolutely looking for a bounce. And also, by the way, are you kidding me on this volume? It's a stock that's doing 3 to 5 million shares a day. Today it did 40 million shares, like 10x. This stock did 10 times normal volume. So you had an excessive gap down, but here's the rub. You had an excessive gap and you're like, well, I don't know what to do with this excessive gap. Sometimes you just say, I want to stay away from it. It's an excessive gap. I'm going to stay away from it. But once you look at the pre-market chart, you sit there and go, oh my gosh, not only is this an excessive gap that should bounce, it's an excessive gap that has a beautiful pattern. This is a textbook parabolic setup, but you wouldn't know that if you didn't have the pre-market chart up. Pre-market charts can only help you. They're never going to hurt you. You should look at them. So what do you get? Wide range bar, semi-wide range bar, and then boom, the market opens. And as soon as the market opens, the stock tanks from 58 down to 54. Look at the volume, guys. 5 to 6 million shares on the first 15-minute bar of the day. Now, I want to say this one more time. This stock averages 3 to 5 million shares a day, and in the first 15 minutes, it's met its entire day's average. Wow. There's some serious interest in this stock. And then a green bar comes in, and you're going to buy it right here, put your stop down here, and what happens? The thing pops $10. Was it about a $2 stop loss? Something like that, give or take. $10, 5 to 1 on your money. All made possible because of an excessive gap of, what was this, 20%, 30%? No, it's like 30 some percent. 75 to 55, $20 on a $75 stock, that's probably close to 30%. And then you see this in the pre-market. Again, what are we doing? What are we doing? Multiple concepts converging in an area makes our trades more reliable, all based off an excessive gap, which means we're going to look to fade it. And then we get the pre-market information. My goodness gracious. There's another example. So now what do we have? Stock on the daily to the left, on the left. Green bar, green bar, green bar, bottoming tail, green bar, green bar, green bar. 1, 2, 3, 4, 5, 6, 7 bars up. 7 bars up. Far from the moving average. $6 or $7 from the moving, 10% away from the moving average. We all know the moving average, you've taken professional trading strategies, is a magnet. Stocks pull back to the moving average. They bounce off it, pull back to it, bounce off it, pull back to it, etc. Well, what do we get here? We got an inside gap from an inside previous day. This is important, guys. So you see this big, huge volume spike right there? Right there. That's on this day right here. See that? See that day right there? Topping tail day, bottoming tail day. What's that telling me? It's telling me buyers are tired. Buyers are exhausted. This stock's not likely to go much higher. And then what happens? The next day, you get an inside day. Albeit a green day, it's a bit bullish, but it's mostly an inside day. Yeah, it peekabooed over the top by a little tiny bit. Mostly an inside day. And then you get this over here. But we know the daily chart is getting tired. We know it's likely to pull back. So our question is, how can we take advantage of it? That's the question. And we get this beautiful 2-minute parabolic setup. Goes from $64 to $67. We see the daily's already extended. Topping tail, topping tail, topping tail. Short it right there, stop right there, boom. Higher time frame bias is short. Our job's to find a lower time frame entry. This is how you properly fade stocks. The average person, the new trader, the novice trader, is looking at this chart and going, oh my gosh, it's so bullish. I want to go long on it. No. Let's tie in one more thing. Remember, like a year ago, we did a lecture where it said, if it's up 3 green bars, think about selling. If it's up 4 green bars, really think about selling. If it's up 5 green bars, really think about selling. Well, this one's up 7 or 8. That's a lot of reallys, isn't it? Think about selling. Think about shorting. Okay? So, topping tail, going to short it right around 66.50, stop $67. Boom. First target, moving average. I'm not going to get into climactics and parabolics today, but we're taking an excessive daily chart, extended daily chart, and trying to find an entry. Okay? You can see it even over here on the left. 2 super wide range green bars, and the stock pulled back. It needs a rest. Stocks just don't go up in perpetuity unless it was, what was that, JKS for like a month. Other than that, they don't normally do that. So this is how we look at that. Now, one more quick comment, and then I'm going to wrap this up. I called the market as a fade today because we're gapping up 3.6%. That's an unbelievably big gap for the market. Not for a stock, but for the Qs. Okay? For the Qs. So bottoming tail, stock market, I should say in this case, moves up initially. And I said, guys, keep an eye on the Qs under 284. Why? Because you're engulfing a bottoming tail and you're already super extended. Now, to be fair, the stock, or the Qs, I should say, the market ultimately bounced and went up to like 287 or 288, whatever it was. But it didn't matter by that point. It went a full 2R. It was a 65-cent stop loss, and it went $2, give or take. It went about 3 to 1. Okay? It went about 3 to 1. Now, why would I ever consider that? Because of the volume in the market. Guys, the Qs on a 1-minute chart had 14 million shares printed less than 15 minutes into the day. Lately, the Qs have been doing 15 or 20 million shares in an entire day, except for some of the crazy days. And we had 14 million shares in the first 10 or 15 minutes of the day. There's some serious interest here. So partly with the Qs and the SPY and the market, there's some intuitiveness here. What I mean is a 3 or 4% gap on a stock is not a big deal. But a 3 or 4% gap in the QQQ or the SPY is like a stock gapping up 20 or 30%. It's a big, big, big deal. Okay? So this was a legitimate short play. Aggressive, but legitimate. And I actually thought we were going to drop more. We didn't. We pivoted and went higher. Well, there's nothing you can do about that. Will we all admit it's unusual? We had an election yesterday. So the market's kind of weighing in on that, so to speak, whatever it is. So we talked about that in the pre-market. There could be some choppiness because you get this once every 4 years. So it's not like you have a lot of data to fall back on what the market normally does during or after an election, especially one that's hotly contested. We don't know. So what was the general consensus this morning? Be careful, sit on hands, really pick and choose your spots carefully. But with this type of a gap, it usually means fade. It usually means fade. Okay, and today it did work. And then ultimately it did bounce and go higher. Okay, so again, like I said, I apologize. I threw this together in the last 30 minutes. I wanted to add about 5 or 10 more slides. So maybe potentially we will revisit this topic over the next several months because I want to go a little bit more in detail, okay, in some of the criteria for looking to fade a stock. But I think we do today have some pretty good basic criteria. For example, on BABA, we talked about the double bottom retest, the huge volume spike, the engulfing bar, all of those things, right? We talked about on this particular stock, 7 days down with novice ending volume, and then it gaps down 20%, right? So you definitely have criteria you can add to your checklist now. So now you know when it's acceptable to potentially fade a gap. And as always, when in doubt, stay the heck out. If you're not sure, just take a picture of it, go back and review it later. You don't have to waste or risk, I should say, risk your hard-earned money on something you're unsure about. If you're not sure about it, don't worry about it. I understand the FOMO, but don't. I would much rather have ROMO than FOMO, right? I would much rather have regret of missing out than fear of missing out, because fear of missing out leads to bad decisions. Regret of missing out means, well, I didn't lose any money on it, and I didn't make any money on it, okay? So I'd rather have ROMO than FOMO. But if you feel confident, if you made it through your checklist, then these are legitimate stocks to trade. Absolutely, you can buy stocks that are extended. Now, one of the things I want to talk about in the next lecture on fading is when a stock gaps up or down, and pulls all the way back to support, is that stock buyable? So it's not technically fading because you're ultimately going in the direction of the gap, right? If it gaps up, pulls back to support, can you buy it? We're going to talk about that next time, okay? We're going to talk about that next time. All right, so again, I hope you guys learned a little bit during this lecture. Like I said, it's going to be a little bit shorter because I just literally threw it together 30 minutes ago, 40 minutes ago. But I hope you learned a little bit about fading. I'm Jared Wesley. We'll get back at it again next week.